Introduction to Standard Cost. Accounting standard cost accounting is a widely used management accounting technique that involves establishing predetermined costs for producing goods or services. This approach aims to provide a benchmark for comparing actual costs incurred during production with the planned costs. Standard cost accounting is a powerful tool for businesses that want to improve efficiency, control costs, and make better informed decisions. In essence, it provides a structured framework for tracking and managing costs, leading to greater transparency and accountability. Defining standard costs. Direct materials. The standard cost of direct materials reflects the anticipated cost of raw materials that go into producing a product. It considers the quantity of materials needed and the expected price per unit. Direct labor. The standard cost of direct labor accounts for the anticipated time and labor rate required for each product unit. It factors in factors like labor efficiency and wage rates. Manufacturing overhead. This standard cost represents the anticipated indirect costs associated with production, such as utilities, rent, and factory maintenance. These costs are allocated based on a predetermined allocation rate. Predetermined cost. Standard cost accounting relies on predetermined costs established before the production period begins. These costs are based on careful analysis and projections, providing a baseline for comparison with actual costs. Establishing standard costs. Historical data analysis. The process begins with carefully examining historical data on costs, including material prices, labor rates, and overhead expenses. This analysis provides a foundation for setting realistic standard costs. Industry research and benchmarking. Researching industry trends and best practices is crucial. This involves comparing costs with competitors and identifying industry benchmarks to ensure standard costs are competitive and aligned with market realities. Expert input and collaboration, involving key personnel from different departments, such as production, engineering, and purchasing, is essential. Their expertise and knowledge contribute to setting accurate and achievable standard costs. Regular reviews and adjustments. Standard costs are not static. Regular reviews and adjustments based on changing market conditions, technological advancements, and other factors are essential to maintain their relevance and accuracy. Variance analysis. Cost category. Standard cost. Actual cost variance. Direct materials $10, $10.50, $0.50. Unfavorable. Direct labor $8, $7.50, $0.50. Favorable. Manufacturing overhead $5, $5.25, $0.25. Unfavorable. Variance analysis is a key aspect of standard cost accounting. It involves comparing actual costs incurred during production with the predetermined standard costs. Variances highlight discrepancies between planned and actual costs, providing insights into the reasons behind these differences. The analysis helps identify areas where efficiency improvements can be made or where costs are out of control. Advantages of standard cost accounting. Cost control. Standard cost accounting provides a structured framework for cost control. By setting predetermined costs, businesses can identify and manage deviations from the plan, leading to improved efficiency and cost savings. Performance measurement standard. Costs serve as a benchmark for measuring the performance of different departments or production units. By comparing actual costs with standard costs, managers can assess efficiency and identify areas for improvement. Decision-making. Standard cost accounting provides valuable data for informed decision-making. This data helps businesses evaluate different pricing strategies, production methods, and investment opportunities. Limitations of standard cost accounting. Oversimplification. Standard cost accounting simplifies the complexity of production costs. It may not adequately reflect the nuances of actual costs and the dynamic nature of production processes. Lack of flexibility. Standard costs are predetermined and may not readily adapt to sudden changes in market conditions or production requirements. This can lead to inaccurate cost estimations. Focus on cost minimization. Standard cost accounting can sometimes lead to an excessive focus on cost minimization, potentially neglecting other important factors like product quality and customer satisfaction. Implementing standard cost accounting. Define cost objectives. Clearly define the specific cost objectives you want to achieve through standard cost accounting. This could include reducing material waste, improving labor efficiency, or controlling overhead expenses. Establish standard costs. Carefully establish standard costs for each cost category, considering historical data, industry benchmarks, and expert input from relevant departments. Implement cost tracking systems. Implement robust cost tracking systems that capture actual costs incurred during production. This data will be used to compare actual costs with standard costs and conduct variance analysis. Analyze variances and take action. Regularly analyze variances and identify the underlying causes of discrepancies between actual costs and standard costs. Take corrective actions to address any significant variances and improve cost control. Conclusion and key takeaways. Cost control. Standard cost accounting provides a robust framework for cost control, helping businesses identify and manage deviations from planned costs, leading to improved efficiency and savings. Performance measurement. It serves as a valuable tool for measuring the performance of departments and units, allowing for objective assessment and identification of areas for improvement. Informed decision-making. Standard cost accounting provides critical data for informed decision-making, enabling businesses to evaluate pricing strategies, production methods, and investment opportunities effectively. Continuous improvement. It encourages a culture of continuous improvement by highlighting areas where costs are out of control and prompting businesses to seek solutions for optimization.